I have an apple. I'm selling this apple for $1. It's a fair price. It's a good apple. But then you walk in. You think the apple is worth more. Maybe you heard apples are the future, so you offer me $2. Then a third guy walks in. He sees you paid 2. He thinks if he paid 2, it must be worth 3, so he pays 3. Suddenly, there are 6 guys in the room. They are screaming, they are sweating, they are fighting to pay $100 for this apple. It is the exact same apple. But here's the problem. Eventually, one guy looks at the fruit, really looks at it, and remembers it's just a piece of fruit. He stops buying. The silence in the room gets very loud, and the price doesn't just drift down, it crashes. This is the cycle. We build monuments to our own greed, call them new paradigms, and then watch them burn. From tulips to dot-coms to subprime mortgages, history doesn't just repeat itself, it rhymes. Today, we are looking at the mechanism of the bubble. Not the charts, not the candles, but the psychology and the hidden math that turns rational people into gamblers. We need to answer one question. Is the artificial intelligence boom a revolution, or are we just holding a $100 apple? Let's be honest, it feels like we're in a bubble. Housing prices in many places are detached from reality. Stock markets are hitting all-time highs. There's a sense of vertigo in the air. But declaring a bubble is dangerous. If you call it too early, you look like an idiot while everyone else gets rich. If you call it too late, you're broke. To understand where we are, we have to understand how a bubble actually breathes. It usually starts with a displacement. A new technology or a financial innovation changes the way we see the world. In the 1990s, it was the internet. Dot-com business means money started off as a true statement. Today, it is artificial intelligence. The narrative is powerful. AI will change everything. Productivity will skyrocket. The future is limitless. In a normal market, price tracks value. If a company makes more money, its stock goes up. Simple. But George Soros, the billionaire investor, proposed a theory called reflexivity. He argued that markets aren't just observing reality, they help create it. Investors' perceptions influence the fundamentals, which then influence the investors. It is a positive feedback loop. When the price goes up, people don't think it's expensive, they think, I was right. The rising price validates the thesis. This is where the math stops mattering and the biology takes over. We are wired to herd. We have a fear of missing out, or FOMO. When you see your neighbor getting rich on something you don't understand, it causes actual psychological pain. So you buy, not because you've done the cash flow analysis, but because you believe there's a greater fool out there who will pay more than you did. You're playing a game of hot potato. This creates what experts call an inflection bubble. This is the good kind of bubble, believe it or not. Think about the railroad boom of the 1960s or the internet in 1999. Investors lost billions. They poured money into companies that had no business existing. But that money wasn't just incinerated, it laid the tracks across America. It built the fiber optic cables that run the internet today. Bubbles subsidize the future. They compress decades of infrastructure building into a few years of mania. So if AI is an inflection bubble, maybe it's fine. Maybe NVIDIA and Microsoft are just building the railroads of the 21st century. Sure, some investors will get wiped out, but society wins, right? Not necessarily, because there's a monster in the basement. The difference between a painful correction and a financial apocalypse usually comes down to one word: leverage. Irving Fisher wrote about this in 1933. He said overspeculation is bad, but it's rarely fatal unless it's conducted with borrowed money. This brings us to the most terrifying concept in economics, the financial instability hypothesis, proposed by Hyman Minsky. Minsky argued that the economy is naturally unstable because it is stable. When things are going well, like the Great Moderation before 2008, people feel safe. Banks feel safe, so they start lending against risky assets. They move from hedge finance, where you can pay your debts with cash flow, to speculative finance, where you can only pay the interest. Finally, they enter Ponzi finance. This is where you have to borrow new money just to pay off the old money, betting that the asset price will keep going up forever. When a bubble is fueled by credit, like the 2008 housing crisis or the Japanese land bubble of the 1980s, it becomes a leveraged bubble. These are the ones that kill economies. When these pop, you don't just lose paper wealth, you get a debt overhang. People stop spending to pay down debt. Companies stop hiring. The recession is deeper, and the recovery takes years longer. Historical data proves this. Recessions following leveraged housing bubbles are significantly more painful than recessions following equity bubbles. So look at today. Where is the leverage? In the AI sector, big tech companies are spending hundreds of billions of dollars on chips and data centers. But here's the crucial detail. Companies like Microsoft and Google are mostly spending cash, not debt. They have tremendous cash flow to back it up. But look deeper. There are startups borrowing money to build data centers for other startups who are paying them with venture capital money. We're seeing circular deals where money is round-tripped between companies to make revenue look higher than it is. OpenAI has investment commitments totaling $1.4 trillion. That is $1 a second for 31,700 years. If the AI demand isn't real, if it doesn't generate actual profit soon, that infrastructure becomes dead weight. But the scarier bubble might not be in the stock market. It might still be in housing. We tend to think housing bubbles only happen when banks give loans to people who can't pay them back. But bubbles can also form just because we think prices never go down. We've seen a disconnect. House prices decoupled from intrinsic value. In many places, prices are high not because of demand, but because no one is selling. It's a standoff. And remember the Minsky cycle. Stability breeds instability. We haven't had a major recession in over a decade, aside from the weirdness of the pandemic. Investors are confident. Risk management is relaxed. This is exactly the soil where Ponzi finance takes root. Howard Marks, one of the greatest distressed debt investors alive, recently wrote about this. He pointed out that market bubbles aren't caused directly by technological or financial innovations. Rather, they result from the application of excessive optimism. He notes that investors dismiss the past. They say, "This time is different." That phrase, "this time is different," is the most expensive sentence in the English language. It is based on the arrogance that we have figured out the secret to eternal growth. But here's the uncomfortable math. If you buy a stock or a house priced for perfection, you need perfection to happen just to break even. If you buy an AI stock priced as if it will replace all human labor, and it only replaces some human labor, the price crashes. In a bubble, the reason for the price increase is the price increase itself. It feeds on itself until it runs out of buyers. This is the greater fool theory, running out of fools. So, are we in a bubble? By definition, you can never know for sure until it pops. That's the irony. If we knew it was a bubble, we would sell and it wouldn't be a bubble. The bubble requires our blindness to exist, but we can look for the signs. Are people buying things just to sell them to someone else at a higher price? Is there excessive use of debt? Is there a belief that new rules apply? If the answer is yes, you might want to stop bidding on the apple, because eventually gravity always wins. And when the music stops, you don't want to be the one holding the hot potato.